My name is Sandy Kory. I'm a founder and general partner at Horizon VC. We are a seed stage and pre-seed stage investor in startups that are building great software products.
Hey everyone, thanks for tuning in and welcome to the VC Architects, the podcast where we share the real stories behind new VC fund managers and the blueprints used to make them successful. My name is Vlad Cazacu and I'll be your host today as we interview Sandy Kory, a Stanford grad with over 100 angel investments under his belt in companies such as Palantir, Canva, Flutterwave, and more. This is an episode you will not want to miss as we uncover the path from boutique M&A firm owner to fund GP and the fundraising story behind it. For more information about starting and growing your venture fund, including show notes, highlight clips, and exclusive scenes, follow us on Twitter and Instagram at the VC Architects, as well as on our website at thevcarchitects.com. This episode is brought to you by Flowlie, the number one choice for deal screening and network management, used by hundreds of investors from 50 plus different countries. Now, let's dive right in. Hey Sandy, thank you so much for joining us on the podcast today. Super excited to have you and I'm really looking forward to our conversation today.
Thanks, Vlad. Very happy to be here.
To start off with this episode, would like to rewind the time a little bit and get back to your first angel check, because similar to a lot of emerging fund managers, some of us that we have on the podcast as well, you started your journey by doing some angel investing. So looking back to the very, very first angel investment, if you can still remember it, can you give us a little bit more details on what it was, why you wrote that check, and what made it a motivation?
Sure. And so the motivation goes back pretty far for me. I went to Stanford, and there I took some classes that were involving tech startups and venture capital. And this was 2002, 2003, that time frame. And there are a few VCs who actually taught one class in particular, and they seemed like they lived on Mount Olympus. Venture capital seemed like an amazing thing to do that I would never have a chance to do myself. But I was interested. And so after I graduated, I did get one interview at a venture capital firm, but it just seemed like a total long shot. And I thought to myself, I'm just going to have to be my own venture capitalist if I'm going to do this. And so I went into investment banking and I found a niche working with bootstrap tech companies and had some success as a relatively young professional. And so I had some discretionary income. And then I think it was in 2006, so about 2 years into my professional career, I had a chance to invest in an angel opportunity. And it was literally the first angel opportunity that came across my desk. And I was clueless and I invested. And so don't invest in the first thing you see. It's probably good advice. 2006, in my defense, there wasn't a lot pre-AngelList, weren't a lot of resources online about these things. Now, a couple years later, in 2009, in the darkest days of the financial crisis in the spring of 2009, I had a chance to invest in another startup called Palantir Technologies. It was an early round, and that was my fourth angel investment. And so I still didn't really know a lot about being a good angel investor, but I did happen to know some of the early employees and founders at Palantir. And they were, it seemed, the smartest people on the planet. And they were incredibly ambitious. And this was a time, March, April 2009, when banks were collapsing and just who knew, which way was up. But it just seemed like a safe thing to do, to invest in some of the world's smartest people building technology. And so I made, at the time, given my financial resources, it was an uncomfortably large investment in Palantir. So that was my fourth investment, and there was definitely a little bit of beginner's luck there, but hopefully I was starting to learn. And that investment did, of course, work well and encouraged me to become a much more active angel investor.
They say the third time is the charm. You just delayed it by one. The fourth time was the charm on the angel investing. Just out of curiosity, relative to your income at that time, how big were your initial angel checks? And looking back to what right now is your portfolio strategy, what would you have advised you at that point your angel checks to be?
I always had an unusually high tolerance for taking financial risks. So I think, so I don't want to advise people to do what I did. However, if you do want to be in venture capital, it's important to have some interest in taking risk and have some intuitions about how to go about it. And so I could have looked at my pretty small balance sheet at the time and said, I'm going to look at X% of my balance sheet. But I really thought about it more as like an NPV basis. And I just had a lot of confidence in my ability to make money. I found a knack in finance. And so I thought, look, I'm going to make a lot of money over the next 20 years. I didn't think I was going to be a billionaire. I still don't think I will. But I did think I could make pretty good income in finance. And so I wasn't worried about losing, say, $25,000, even though I might have only had $100,000 in my bank account. And so my first angel investments were probably unusually large. And then the Palantir investment was even larger. And that was also motivated by me just not having a lot of confidence in putting my money in the conventional safe places, because this was a very scary time. And it just seemed like giving the money to the smartest people to manage my capital might be just as safe as giving the money to, say, Bank of America with more upside. And then later on, I would say I became a very active angel investor, and other people had better track records than me as an angel investor, although I think I did build a very good record. Other people with more wealth had probably put more money into angel investments, but I might have won the prize in terms of investing the highest percentage of my after-tax income. I was living in California, paying a fair amount of taxes, and I did a calculation over the 10 years where I was most active as an angel investor. I invested 62% of my after-tax income into angel investing. And this was before I was married and had kids. And so from a personal perspective, like I said before, I was just comfortable taking those risks. And not everyone is going to be comfortable with that. But for me, it was definitely very useful. I think having skin in the game is a great accelerant for investing. And so I think it really helped me to learn and be especially motivated to learn and to just make sure I wasn't blowing my money. And so while
Absolutely.
the risks I took were aggressive, I do think there was some prudence there, and I was always quite humble. I was aware that I was that there's a multi-year journey, and I thought that if I was humble and interested in learning, it would work out. And it has, although I'm certainly still a beneficiary of good fortune.
Fantastic. 62% of your after-tax income, to have it as an allocation towards venture as an asset class, it's quite, some people would argue it's quite risky. But I'm curious, from that very first angel investment, the very first angel opportunity that you got, to now almost, 100 angel investments. I'm curious, at what point in that journey you said, no, like, I feel like I know what I'm doing. I'm going to make this a larger part of my time. And maybe at some point you knew or you didn't know that you're going to make that your career.
So I worked for a few boutique M&A advisory firms, and actually in mid-2010, I got let go by one. I was running the kind of a small tech division at a small firm, and I had a few clients that I was able to kind of take with me and then start Horizon Partners with my partner, Mike. And so mid-2010, I didn't make really any money for 18 months or so. But then the M&A business, once you start closing deals, it can be a good one. And so I started having some cash flow in 2012. And I looked at all the investments I had made, and I had done some investing in public markets and just things that normally finance people might consider. And the best thing in my portfolio back then was Palantir. And so that was encouragement. I was humble in the sense that I didn't think I was super expert at it. I said, look, this is the best thing in my portfolio. It also was complementary to my day job advising bootstrap technology companies on mergers and acquisitions. And so it was funny. And years later, I realized it's actually a pretty good heuristic. If you ask an investor, any investment manager of any asset class, you say, what was your best deal from 3 years ago, or 5 years ago, 7 years ago? That's probably their strategy. And so every VC is going to have a shiny, nice strategy, and every hedge fund manager, if you want to cut through some of the marketing speak, just say, hey, what was your best deal? So for me in 2012, my best investment was Palantir. And so I said, hey, let's just lean into this. And like I said, I had confidence in my ability to make cash. And I didn't think I was going to lose money. I figured worst case was maybe I'll just break even. But it was very fascinating to me. Probably it would have been a little smarter on a risk-adjusted basis to, say, go into like real estate investing. But that just wasn't very interesting. And I think I had this deep-seated interest in this venture from my days as a university student, where it seemed this kind of impossible goal of becoming a VC. And so I just figured, hey, maybe I can figure this out on my own. And it was really my side hustle or my kind of weekend job. And so I was living a double life for many years. I was advising bootstrap tech companies on M&A in the day. And I think bootstrapping is wonderful. I don't have an ideological view, as some do, about bootstrapping versus raising capital. I was working with the bootstrappers on the one hand, and then nights and weekends, I was looking to invest in startups. And it was funny because sometimes the startups would say, hey, do you just want to sell me? And I was like, no, I'm looking to invest in the next Palantir. Palantir's not going to hire me. Maybe Palantir could have hired Goldman Sachs at some point, but obviously they're a public company. And so it's like I wanted to invest in those startups that were going to never sell and try to build large, important companies. And so that was really motivating for me. And it was something that I really pursued more and more over the years. And then late 2021, I had a chance to raise a fund. And I had just grown more passionate about the investing, and my record had gotten to be, I think, good enough that a lot of people would be interested in a fund. And so I decided to step back from the M&A business. I've got a wonderful partner, Mike Firmage, and so he runs the M&A business. And I started Horizon VC. Mike certainly helped me get off the ground and is an important resource at the firm. But I'm like the main, day-to-day operator of the fund. And so over the past 18 months, I've now been a full-time VC, and it's been a real joy and a learning experience.
Let's zoom in a little bit on that moment, right? You've acquired a pretty robust angel portfolio. You realize what works, what doesn't. I got even more excited about it, and the aura of the sexiness of venture capital really took over, right? As you mentioned, right? That unattainable goal at Stanford where everybody's speaking about it, and you figure out how are you going to get in, and now you're in the arena with skin in the game. You've made a number of angel investments, and you're saying, you know what? I feel at this point I'm ready to take on the responsibility of other people's money, and I trust myself that I'm going to make great investment decisions and return capital to them. Walk me a little bit through that decision-making process of moving from your own balance sheet to a balance sheet managed on behalf of others with a fiduciary responsibility to those LPs.
Sure. And there's another important aspect, which is that I genuinely thought and think that I can help founders. In the M&A business, I was successful with my partner. It was a service business. And so I had a service mindset about how do you go above and beyond to help the client. And so as an angel investor, I tried to have a similar approach, to just be as helpful as I could with companies that I invested in and founders that I didn't invest in as well. And so I did think that I was going to be able to do that. I think there are some VCs who are really good at getting in deals. I don't know if they can add a lot of value. Of course, there's some VCs who don't even think it's possible to add value. So there's a lot of philosophy and debate there. But I did think that I could be helpful, and I thought that was an important milestone in terms of wanting to go full-time into VC. And over the years doing angel investing, I did bring other people into many of the investments that I made with no economics. I had a couple of people that I brought into the Canva deal, for example. And I did bring people into a few deals that were not good. But overall, the investments where I brought friends, people from my network into these deals, it was a very good record. And then also in 2021, I put together some PVs with my business partner, and those also performed quite well. And then also in the M&A business, I had just built a lot of trust with high net worth individuals that had been clients. And so I had this philosophy where I had been able to really help a lot of people make a lot of money. And then I was able to, I think, raise the fund relatively easily. And I had friends who started funds in the past who I thought were really good investors. And I saw that they often had to spend 75% of their time for the first 2, 3, 4 years pitching LPs and asking strangers for money. And I didn't really want to do that. And so I thought to myself, I'll do a fund if it ever seems like downhill to raise it. And fortunately, in late 2021, that was the case. Now, in hindsight, that was the peak of a bubble, and I certainly benefited from the timing there. But I was asking people to invest in a fund who had already made a lot of money with my help. And then also, I was the second biggest LP in the fund. My partner, Mike, is the third biggest. That helps a lot. And then we also did something unusual with our fee structure. So we did an unusually low management fee. Typical industry norms are 2 and 20 fee structure. And so we did a 0.5%, 25%. So a little higher carry, much lower management fee. Because I just didn't want to make money unless my investors make money. And I think that there definitely are cases where VCs can make a lot of money from management fees, even if the performance is terrible. I just didn't want to do that, at least not on Fund 1. And
For sure.
On any fund. But I just really wanted to send a signal of, look, I've got a lot of skin in the game. The incentives are very well aligned here. And so I think that kind of came together along with my record where people said, sure. And they were people committed pretty quickly. And then having these M&A relationships was helpful because those were these high net worth individuals where we had advised them when they sold their businesses for 20 million, 50 million, a couple hundred million. And so between my LP commitment, my partner Mike's LP commitment, and these M&A clients, maybe a half dozen who were maybe on average like low 7-figure commitments, like that was like an anchor tenant, if you will. And so we didn't really spend time soliciting institutional investors. Talked to a few, but I had never really pursued that. But we were able to get the first half of the fund very quickly, just from people from ourselves and people that we trust. And I think just like in raising a round of your startup, I think it's like getting that first half, getting the lead is the hardest part. And then once you have that, you get some momentum, and often it's quite a bit easier to get the rest of the folks in the fund.
So let's discuss a little bit about that initial piece of the fundraising, right? Obviously, outside of you and your partner commitment, you mentioned the relationship from the M&A and all the synergistic work that you've done in the past, your network, the people who've invested with you in the past and made money, which is always a great selling point for a new GP to tell their LPs. Walk me a little bit through the very first non-GP commitment. What was the first person or the first entity that you said, okay, there's someone else interested in this and they're committed, we're off to the races?
Honestly, I just knew I was fortunate. There was easily a dozen people where I was certain that they would invest anywhere from $250,000 to a couple $1 million. Like we had done these SPVs, and so we did 2 SPVs in the company. This was in early 2021. And then 8 months later, it wasn't like a typical VC deal. It was more of a growth equity deal. But we invested maybe $6-7 million into 2 SPVs. And then 8-9 months later, we got liquidity. And I don't remember the details, but like the exact specifics. But basically, if you invested $1 on average, like you'd get like $1.75 in cash and then 75 cents in stock in another company in 9 months. So that was a really good return. And so we had people who invested in those SPVs. And so I was quite confident that they would be willing to invest in the fund. And so it was, I never had a meeting where I was like really nervous about, hey, is this person going to invest or not? There's a question of how much, but there was just like, so I guess to isolate it, I mean, there was just a lot of trust, and so I think if you can have really high trust relationships with people that have wealth, I think that helps a lot, right? And even if you're a very trustworthy person, it can take a long time to build trust. And so I think that I was quite patient over the years and just got to know lots of people over many years and kind of showed that I was very much someone who's going to do what I say I will do, and that I was going to put other people's economic interests above my own if there's ever a question. And I was going to work really hard, and I was pretty smart. So I think people thought there's just not a lot of downside. Kind of like when I was investing in Palantir, didn't really know. I wasn't like a super expert on, but it just felt like a good thing. And so I think that was the case with our LPs. We just had these really high trust relationships. That's unique. I don't think most emerging fund managers will have that dynamic. I think if you've been like a wealth manager or an M&A advisor, or you've been kind of like a financial advisor for many years to build these relationships, well, there you go. That can be a nice bridge. Obviously, there's other ways to do that, but that was certainly the bridge that worked really well for me.
Absolutely. Depends how early you start the work, right, on building those trustworthy relationships. Those are things that are built over time. And quite frankly, you had the opportunity through your other work to build those relationships and through your angel investing and extended your ability to invite other people into those angel investments, have slowly built a joint track record as, quite frankly, a syndicator, right, a manager of other people's money in a sense, an introducer of good opportunities to them. So I'm curious, did you at any point had to go outside of the close network to fulfill the size of the fund?
Got a first close of $36 million, and that was, I want to say, late January of 2022. And I think we officially started raising money in December of 2021. I actually had COVID and was sick for a couple weeks, so I probably didn't really do any real work until early January when I was healthy. My partner Mike was probably doing some work in December, and he also was critical in raising money. And he went to a few people that were kind of like friends of friends, probably a little bit more outside of his immediate network than me. But similarly, he just had a very high trust community to leverage, and we just didn't do any cold outbound, which is ironic because, look, I do cold outbound with founders, and in my M&A business, I was extremely active doing outbound over the years, and often would build relationships with founders from an outbound email, outbound call over many years. But in the case of the fund, we just actually didn't have to do that at all. Maybe it's a good thing. Maybe actually there's definitely like a battle testing. There's like a hardening that you get if you're out there not going to endorse. And so I kind of skipped that step. It was great though, because I could really immediately dive into investing and not have to be divided with spending a bunch of time on fundraising. So we had our second close in it was April and May of 2022, and so the fund ended up being $44 million. And in the few months between the first close and the second close, I probably spent 10% of my time on fundraising, but it was a pretty low pressure, pretty relaxed, and mostly just talking to people in the network who had expressed some interest.
Definitely not a traditional fundraising journey. part network, but also a little bit on 2021, 2022, great year to raise a venture capital fund. I think people were a little bit more open to the asset class from an LP perspective, given all the buzz around it. But I'm curious to understand a little bit from a fundraising perspective, the value prop that you're offering. Obviously, the trust in your track record, etc., count a lot. But regarding the thesis and the positioning of the fund, what were you promising investors? What were you communicating to them that your strategy will be to generate alpha in this market?
I had the most success investing in software startups, and then in particular, startups follow the bottom-up business model. Sometimes it's called PLG or product-led growth. And so I emphasized that would be a major theme. But I didn't want to lock myself in too narrowly to doing just that. And so it was really the pitch, if you will, what was more about, hey, I've got a great record. You've made money through me. Maybe you've invested in my deals so far. And I'm very interested in finding great founders. And how do you do that? I can talk at length about how do you identify great founders. And certainly I don't have it totally figured out, but I have a good record of finding some great founders to back, and then great business models. And so I think software-based business models are probably the best business models. And over the years, I've become maybe a bit of a connoisseur of those scalable business models. And founders really dedicated to solving a problem with software. And that's the essence of the fund. It's not the sexiest thesis. And I realized I didn't have the kind of sexy story that most institutional investors would be looking for. I didn't have a super popular podcast. I had a couple followers on Twitter or LinkedIn, but certainly nothing dramatic. So it was really more about, look, I've got a really good record. People have a lot of trust in my judgment and my integrity. And so people were willing to back that. Yeah, it's not the easiest strategy for an emerging manager to try to follow. But I think the one thing that I would advise emerging managers or people who want to raise a fund on is really just going out of your way to be trustworthy. For example, I mentioned that I brought people into deals without taking any economics. I did that many times. I could have probably done an SPV or something like that. And I don't want to begrudge anyone who does that. But I think if you don't do that, if you just show, hey, look, I'm not trying to monetize this, I think people notice that. I didn't talk about it, but I think people notice. A couple years later, I did something similar in a startup, actually a kind of a biotech diagnostic startup, a really promising startup called Building.Considerations. And in that case, I put together a partnership. So I did a little bit of work to kind of create an entity, bring a bunch of people into a couple of their rounds. Didn't take a penny. Again, didn't do an SPV. And I think people notice that. And so those are just some examples, but it's when I think people will notice when you go out of your way to create value, and your own economic interest is secondary. In the long run, I think it's really important to capture value for what you do. But I just thought, hey, I would just be more focused on creating value, building trust, and then for the long run, things will work out. I didn't think I was really going to do a fund back when I was doing those things, but I just always have had a view that you just want to go out of your way to build credibility, when people build trust, and then good things will happen. And then late 2021, when things did coalesce and I had the chance to raise the fund, it was a time to tap the credibility and the trust that I built with a lot of people over the years.
Absolutely. The whole ethos of give first, doing it long enough and well enough and consistent enough, people will notice. And it's the subtle cues that will give people that trust and relationship building with you as well.
And look, I actually think it's a great strategy for building a software startup. Let's take Canva, right? And so they have been a kind of an SEO machine over the years. But really, for them, they've created a huge amount of great content, all these design templates, but it's really about leading with value, right? So I think in the internet economy, the best leading indicator of revenue is creating value. And not every startup will follow this path, but I think for the founders that are really focused on creating value, often through a website with content, but there's other ways to do that. I think if you're doing that, you're just going to learn a lot about how to create value, and then that will be something that you can monetize. And Canva is a great example. Our first product had some traction, kind of the free product had traction. It didn't really monetize for initially, but they were really smart, learning how to create value, building that muscle. And then with that knowledge, they were able to tweak a few things in terms of their monetization strategy, and then it was off into the races. So yeah, I'm a big fan of focusing on learning how to create value. And then once you do that, you've got this muscle, and it's you'll be able to create plenty of monetization if you've got that muscle.
I'm curious, how are you seeing the current market and access, right, to pre-seed and seed deals with the advent of quite a number of pre-seed and seed funds being created over the past 2 years? Do you see increased competition? How are you thinking about deal access in today's environment?
It's a crowded, there's no doubt about it. I think that the seed asset class from 2006 through 2015 performance was very high. And then markets are, I think, reasonably efficient. And so more and more people moved into the asset class. And then the past couple of years, the seed has really just gotten very crowded. You've got the kind of bigger funds, multi-stage, who are often too scared to deploy capital in big increments at later stages where they might have in the past been most comfortable. Maybe they got ahead of their skis in 2020, 2021, maybe 2022. And so a lot of those people are moving to seed. So it's a great, I think, market for founders. It doesn't mean every founder is going to raise money, but I think on average valuations are higher. And I don't think that's necessarily better for companies because rounds are bigger. And I think that it's really hard if you're a founder and you have a chance to raise like a big round at a big valuation. It's hard to turn that down. But I think it's a little bit like going to the grocery store when you're hungry. I think it just creates an environment where there can be a lot of distractions. And so anecdotally tend to see higher performance with founders who are keeping rounds smaller and just focusing on being more efficient. Because I'm investing pre-seed, seed, when founders are pre-product market fit. And I think that if you have a lot of money, you might be tempted to try a lot of different things on the path to finding product market fit. But I think that the evidence experience shows that keeping a team very nimble and very focused on a few things is the best way to iterate rapidly. I think that's the key to finding that tight product market fit. So yeah, it's an environment where there's a lot of funds, bigger rounds at the seed stage. I don't think that really is great for performance in the asset class. And I don't think it's great for performance for founders, to tell you the truth. But venture cycles can be long. And so we've probably got a couple years here where it's going to continue to be crowded at the seed stage. Ironically, there's less money at the Series A, the Series B. If I was a big LP, I'd be more interested in backing new funds that are investing at the A, the B, and the C, because a lot of those existing players are chastened, not active. And because there is a lot of seed funding out there, I think there's a lot of great companies that are going to be popping up. And so there's probably more opportunity at the later stages. But I really do love the seed stage and just being involved at that earliest part, trying to be helpful at that earliest part. I think that it's just a really wonderful time to be an investor. So I'm committed.
Before we go into the rapid fire question, I would like to ask a little bit on the portfolio construction. Outside of your thesis, how did you start thinking about your target investments, your check size? How much size the fund you'd like to be as you were starting to raise the fund? And has that changed at all now, 1 year into the deployment of the new fund?
When we started the fund, the lower goal was 30 million. That was kind of like, look, if we can get to 30 million, I think that'll be a success. And then we were able to get to that pretty quickly. And so then it was like, okay, 40 million would be nice. And then we settled at 44 million. I think we would have capped it at 50. Maybe in the future we'll do bigger funds, but I admire the benchmarks, the home brews funds that are not trying to maximize their AUM, that are committed to a certain fund size based on a certain strategy in a certain stage. So that was our thinking. And then we're following best practices around having a diversified portfolio. I think there's multiple reasonable approaches there. I think there's probably good advice to first-time fund managers to be a little bit more diversified. If you might have instincts to be more concentrated, more diversified, but it's probably better to err on the side of being more diversified for a fund one, just so you have a few more shots on goal, so that if you do want to raise a fund two, you just have a few more shots to show startups that are showing kind of breakout potential. So we'll probably end up with a portfolio of 25 or 30 startups for the fund. We're about 25% deployed, going at a pretty measured pace. I think being a major LP probably it makes me a little more likely to be patient than if I didn't have the skin in the game that I do.
I'm curious, are you already thinking about Fund 2?
When I'm doing something, I want to do it well. Part of that is just wanting to do things the right way. Part of that is being competitive. And so I think that it's like if you're running the race, you need to run through the finish line. If you let up at the last second, like you might lose, right? And so I think that for now, it's a good working theory to say, yeah, I'm going to do a fund two. I want to do things well enough so that there'll be an opportunity to do a fund two. I suppose I could say, nah, not going to do a fund two and still do a good fund one, but it feels to me like I should be thinking about a fund two and having some ambition, having some long-term planning there. But I'm not thinking a whole lot about it. We're in no rush. Yeah, probably a little bit more patient than average, just given the LP dynamics. And then also with the market conditions, I don't feel like it's a great time to be moving quickly to deploy capital. So right now, not doing a whole lot, except trying to execute on the strategy, trying to do the things that we should do to have a great fund one.
And are you thinking of expanding the team? Are you thinking of continuing as a dual GP while you take the main role on the VC, while your partner takes the main role on the M&A side? What's your thinking around the actual firm that you're building?
Look, it's a great question, and I would say it's still a work in progress. I do want to grow the team, and so we actually are starting to talk to junior candidates. I think my frame is really, look, as an LP, I'm a capitalist who wants to fund and deliver big returns, and so what's the right approach? Sometimes having a very lean model of just one guy or one gal can be a great approach, but I do think that bringing on a great person could help to expand the network, find more great deals, be even more helpful to portfolio companies. And I think that intellectually, I'm open to bringing on another partner. I think the bar is higher. It's a much higher stakes decision. And so, of course, hiring a kind of a junior team member, someone who might have 1 to 5 years of experience, like that's important. It's high stakes. You don't want to mess up on that hire, but it's not as high stakes as bringing on another partner. So I think in the near term, kind of this year, the plan is to bring on a junior team member. And then at the same time, in the long term, I'm certainly opportunistic about potentially bringing on another partner. But I think in that case, the trust factor is really important. And so it's like limiting yourself to people that you're just getting to know quite well. So I'm not actively casting a wide net for partners, but I think a couple of years from now, I think we'll probably have another partner on the team and we'll be making progress towards firm building.
It's an interesting dynamic, right? When you're angel investing or family office investing out of your own balance sheet, then moving that to taking LP money and being responsible for them, and now thinking, okay, do I want to create a firm around this? And am I now passing on the trust that's been bestowed to me to someone else who's now co-managing this pool of capital that I'm also an LP, big LP. It's a big responsibility and a big step. Sandy, this has been really great. I want to jump into the rapid fire section, a mix of work, travel, and personal, just to get a little bit unpacking on who Sandy Kory really is a few minutes before we wrap up the episode. Really quick, what is one thing that people don't know about you that you think that they should?
Well, just timely, I would say that I studied psychology as an undergrad, and I've always been interested in psychology, neuroscience, and then something that's been particularly interesting in the past couple of years is psychedelics. And then actually this past weekend, I did something a little out there, if you will. I did an ayahuasca retreat. It was a really intense but a very gratifying experience that, I don't think people would guess that I'm a person who would have done something like that.
I think we'll need to unpack that in a whole nother episode because I do have a lot of questions about it. I've been recently fascinated about the topic. Curious, who's the person that you look up the most, and could be outside of the industry, not necessarily professionally related?
Yeah, look, I'm so grateful to have two wonderful parents. If the question is more around who do I have the most to thank in my life, it's them for sure. It's not even close. But then professionally, I've gotten some great mentoring from some other VCs. For example, Nikki Shavak, who's the founder of Blackbird Ventures, which is just an amazing venture fund where I've been fortunate to be an LP for many years. And so watching them build a firm has been really amazing. Mark Sugarman of MHS Capital, he has kept a much leaner model, but has investing kind of judgment as good as anyone. And so I've gotten to know him very well over the years and learned a lot from him. Those are a couple VC mentors, if you will, that I've really been fortunate to get to know and learn a lot from over the years.
Quick and honest reaction. Wake up one day and Elon Musk is replying and ripping on Bill Gates on your tweet. What was your first thought that morning and how you reacted?
I thought, wow, this guy is either like really insecure or playing some really weird game. Very thin-skinned it seemed. And then for me, it was, a moment of self-awareness of like, oh my God, there's like 1 million people looking at my tweet. And then there's also a million kind of the Twitter anonymous lunatics out there who are all obsessed with Bill Gates conspiracy theories. But it's funny. It was just I was trying to be complimentary because Microsoft has been following OpenAI since I think 2016, and Bill Gates has been pretty hands-on, even though he's been like one of the world's wealthiest people and has a lot going on. And the fact that he was seemingly hands-on in AI for many years, I thought that was interesting. And then Elon Musk saw my tweet and decided it was a good opportunity to rip Microsoft and OpenAI, which seemed to be coming from a place of weird psychic angst.
Indeed, made that tweet quite popular in a very probably unexpected way when you first wrote it. As we end the episode, we'd love to end with this question. You may have answered it already in the previous one, but if you were to give one thank you at the end of this episode, looking back at your career, who would it be?
Well, my parents, certainly. I'm very, very fortunate that they were very supportive growing up, and I was able to graduate from college without any debt thanks to them. And so that certainly gave me probably extra financial comfort to take the high-risk path that I did take.
Fantastic. Well, this was a great pleasure. Thank you so much, Sandy, for joining us on this episode of The Venture Architects. Really much appreciated. And hope to see you again in a few years on this. We'll talk about Fund 2.
I would look forward to that. Thank you very much, Vlad. It's really been a pleasure.
What a great conversation. If you enjoyed it, make sure to like and subscribe to our podcast and be on the lookout for a new episode in 2 weeks featuring another amazing fund manager and their story. This podcast was made possible by Flowlie. If you're a fund manager, angel investor, family office, or syndicate lead who receives a lot of deals or simply wants help sorting through the noise, create a free account today on Flowlie at flowlie.com. That's FLOWLIE.com. And get access to an AI-assisted deal screening engine and network manager that will dramatically improve how you work. Are you ready to take your investing journey to the next level and join hundreds of investors across the globe who use the platform every single day? Find the discount code in the show notes and sign up today. That's it for today's episode. See you next time.